Hey everyone, and welcome to The Explainer. I am so incredibly glad you're joining us today because, honestly, we've got something pretty fascinating to unpack. We're decoding the current state of the global diamond market, digging straight into the core findings of the July 2026 Rappaport Trade Diamond Index report. If you think the diamond trade is just about digging up stones and setting them into rings, well, you are in for a bit of a wild ride today. The market right now, it's this incredibly complex web of shifting supplies, super picky consumer demands, and real economic pressures that are completely reshaping the industry. So let's get right into it. Okay, negative 27.29%. Just let that sink in for a second. That is the dramatic year-over-year drop in the performance of half-carat diamonds. If you just heard that number completely in isolation, you'd probably think the sky was absolutely falling on the diamond industry. But as we're about to see, this massive drop is essentially serving as a chaotic backdrop to a market that is suddenly, and quite surprisingly, pivoting. It's really not just a story of decline, it's a story of transformation. And it's being driven by incredibly specific supply shortages and rapidly shifting consumer tastes. So, to make sense of this wild pivot, here is our roadmap. First, we'll hit global diamond market trends. Second, the fancy shape boom. And third, regional market snapshots. All right, let's kick things off with Section 1, Global Diamond Market Trends. The macro pressure we're talking about, it's really brought to life right here. Look at this visually striking 3-month downward trend in 1-carat diamonds. From April right through to the beginning of July 2026, the performance index for that benchmark 1-carat stone has just been sliding steadily downhill, dropping over 2.5%. This completely anchors our narrative for today. We're looking at a market that has been under consistent downward pressure over the last quarter. That pressure is ultimately tightening global supply and forcing the major players to entirely rethink their strategies. In fact, things are so tight that De Beers is even expected to reduce rough prices or at least expand their discount deals at their next site, just to adjust to this new reality. But wait, here's where it gets really interesting. The real story is kind of hidden inside the data. I want you to scan the year-over-year red numbers, like that nearly 26% drop for 3rd-carat stones and the over 27% drop for half-carats we just talked about. Brutal, right? But then look over at the weekly and monthly columns for those exact same smaller stones. You see these tentative little green recoveries? 3rd-carat diamonds are actually up over 4% for the month of June and up 0.44% for the week. Half-carats? Up over 1% for the month. Why on earth is that happening? Inventory drops. Plain and simple. The supply of these specific smaller stones has shrunk so drastically that prices are actually bouncing back, even while the larger long-term trend looks pretty grim. And that actually brings us to this crazy contradiction at the very source of the supply chain. If we look back at the global 2025 rough diamond production, the actual volume of diamonds pulled from the earth dropped by 8%, falling to 99 million carats. Makes sense, right? The total value of that rough also dropped by 3%, down to $9.2 billion. Yet, and here's the kicker, the average price per carat actually increased by 6% to $93 a carat. So we have less total volume being mined, with Russia still remaining the largest producer, even though Alrosa paused at several Moz mines, but the rough that is being sold is commanding a higher average price. It's basically a classic squeeze, and it's putting massive, massive pressure on the folks who are actually cutting and polishing these stones. So what happens when all of this finally reaches the consumer? Let's jump into Section 2, the fancy shape boom. Here's the bottom line. The 2026 diamond consumers is, well, they're incredibly strict. On one side of the market, you've got high-quality fancy shapes. These are in desperately short supply, and because of that, they're commanding massive premiums. If you hold a perfectly cut fancy diamond right now, it is a prized possession. But on the exact flip side, you have fancy diamonds with bad proportions. The report doesn't mince words about this at all. These stones are completely illiquid. They simply will not sell. Today's buyer knows exactly what they want, and close enough just doesn't cut it anymore. So what exactly are they hunting for? It's all about the elongated shapes right now. They are flying off the shelves, particularly in the 2-carat and larger categories. Marquises are totally leading the pack. They are currently sitting as the most expensive fancy shape on the market. But right on their heels, you've got elongated ovals, long radiants, and emeralds. Antique cuts and styles are also incredibly hot right now. It's this total, undeniable shift away from the traditional standard round diamond towards these visually striking, finger-lengthening shapes. To really put into perspective just how powerful this specific shape preference is, get this. Buyers are literally willing to pay a 20 to 25% premium for a long, cushion-cut diamond compared to a square one. Actually, think about that for a second. It's the exact same style of cut, but just elongating the proportions makes the stone infinitely easier to sell and drastically more valuable. It perfectly illustrates how hyper-specific consumer preference is entirely driving market value right now. All right, let's see how this all plays out on the ground in Section 3, Regional Market Snapshots. Starting off in the US, the market is actually holding steady, even with a lot of businesses having closed for the July 4th holiday. What we're seeing is solid demand for standard round diamonds, or memos, the diamonds lent to retailers on consignment, are actively converting into actual sales. But the real headline here is the shortages. There is a surprisingly tight supply of 1-carat rounds, and good luck trying to find a 3-carat diamond, especially in those super hot, long, fancy shapes. It's really tough. Interestingly, though, there's a booming market for branded antique jewelry right in that $5,000 to $25,000 sweet spot. So for the upcoming holiday and engagement ring shopping seasons, American buyers are going to walk into a market where the exact stone they want might be remarkably scarce. Bouncing over to Europe and the Middle East, we've got this really fascinating contrast. In Belgium, rare categories and collection goods are doing wonderfully amidst all these supply shortages, while standard commercial goods are just weak. Ovals and pears are performing beautifully out there, but like we mentioned earlier, the proportions have to be absolutely flawless to sell. Meanwhile, over in Israel, the market is pretty quiet following the Las Vegas shows. They are seeing a slight upturn in prices, but, and here's the catch, that upturn is being driven almost entirely by low production and supply constraints in places like India. It's not a surge in consumer demand, it's a total supply-side squeeze. Wrapping up our world tour over in Asia, Indian manufacturers, especially the smaller businesses, are under intense pressure. Remember that high average price for rough diamonds we discussed? That is really squeezing the Indian traders right now, though they're crossing their fingers that domestic retail picks up ahead of the upcoming August shows and their wedding season. But then, in stark contrast, look at Hong Kong. Jewelers there are reporting huge sales gains, but get this, it's not primarily from diamonds. It's being driven by a massive surge in gold prices and demand. To give you an idea of the scale here, Look Fook reported a 29% full-year sales gain, hitting $2.2 billion, with their profits skyrocketing 89%. And that was largely boosted by gold. It just goes to show how diverse these regional pressures really are. And that brings us to our final thought for today. We are looking at a global diamond market where overall rough production volume is shrinking, the cost of that rough is rising, and the end consumer, well, they have absolutely zero tolerance for anything less than a perfectly proportioned, highly specific fancy shape. The tension between this shrinking global supply and the intense, hyper-specific consumer preference is just incredible to watch. So the question I want to leave you with today is this. With these colliding forces, who is truly going to control the value of tomorrow's diamonds? Is it the mining giants pulling fewer stones from the earth, or the meticulous consumers demanding absolute perfection in every single cut? Thank you so much for exploring this with me today, and I'll catch you in the next explainer.